All right, good morning, ladies and gentlemen, and thank you for joining our latest series of webinars with Siegel of Siegel Asset Management Partners. My name is Paul Duran. On behalf of the entire team of ELCO Management, I would like to introduce Yves, our sub-advisor for the energy transition portfolio and income infrastructure portfolio. I would like to remind everyone that today's call is being recorded and a replay will be available. If any questions should arise, please enter them in the Q&A box on the bottom of the screen. Now I'm just going to share some important disclosures. And there we go.
Yeah, there we go.
All right,
well,
I'll hand it over to you.
All right, thank you, Paul. I think we can get, yeah, there you go. Good morning, everyone, and thank you so much for joining us. I'm really fortunate to have the management team of DT Midstream with us. From the outset, I should say that DT Midstream is one of our core holdings in the infrastructure income portfolio. And as I was mentioning to David and Jeff, these guys are making me look smart because the stock has performed so well. On the bottom of the screen, I think, is David Slater, who's the CEO of DT Midstream, and on top is Jeff Jewell, who's the CFO. And again, thank you guys very much for doing it. The purpose of this fireside chat is really twofold. Number one, DT Midstream, David and Jeff have a great view on the macro environment for natural gas. And this might be confirmation bias on my part, but I think the outlook for natural gas is really strong long term. And I'm hopeful that that'll be confirmed with this call. So number one is to talk about the natural gas macro environment. And then number two is to talk about DT Midstream, which, as I said, has been a terrific stock for us. And I think the long-term outlook is quite good. Just to level set for everyone, DT Midstream is a pure play, fully integrated natural gas midstream energy company. I think what you want to highlight here is it's a pure play natural gas company. The company serves producers and end-use customers across the southern, northeastern, and midwestern United States and Canada. Think Appalachia Basin and think the Haynesville. Pipelines, interstate and intrastate, represent approximately 2/3 of the company's earnings. And that's been a little bit of a switch. Gathering is the balance, but because of investments the company has made, pipeline has become a more dominant part of the outlook or of the company. As I alluded to, the stock has done exceptionally well since the company was spun out of DT Energy on July 1st, 2021. How time flies by. The stock year to date is up about 57% and is trading just around its all-time highs. Just to level set for everyone as well, the energy sector has been the worst performing sector in the S&P 500. It's up about 8% versus roughly 22% for the S&P 500. However, within the energy sector, midstream companies are up about 35%. And as I said, DT Midstream is near the top of that. So with that introduction, thank you everyone for joining us, and thank you David and Jeff as well. And if I could start off, David, would you like to talk about what you're seeing on the macro environment for natural gas?
Sure can, Yves. And before I jump in, just want to thank you and your firm and all your clients for the support over the 3 years since we spun the company. Always enjoy our fireside chats. So with that, why don't I touch on, maybe I'll touch on the fundamentals. I'm going to break it up, Yves, into short-term and long-term, because I think there are two separate items here that are driving the market right now. So I think in the short term, the one thing that's impressed me this year is the discipline the producers have exhibited in the face of really weak commodity prices. We came out of a very warm winter last year with all-time high surpluses in storage inventory. Producers really battened down the hatches, so to speak, and slowed down the drill bit. And over the course of the summer, we've been what I'll call balancing the ship and burning off that storage inventory excess. In the background of that, we've had a very strong power burn this year. We've been outpacing the forecast pretty consistently all year, regardless of winter or summer, which I think will kind of play into some long-term fundamentals that we're observing. We've also been kind of monitoring the LNG growth and timing issues related to LNG growth, and we've seen some timing pushes on some projects, which has pushed out demand, which I think is also factoring into the short-term price environment. And as we head into the winter season, I think the whole short-term energy complex is focused on weather again, winter weather, and how that will affect price. So my sense right now is the ship is righting itself. We're going to go into the winter with approximately the same storage inventory that we had a year ago going into the winter. So we burnt off, almost 500 BCF of excess since kind of that really mild winter we experienced last year. So it feels like, to me, we're on the road to price recovery. And we'll see as Plaquemines comes online here. We expect that's going to come online in the next couple months. We're seeing on our system feed gas being delivered to the facility. So we physically connect to that facility and we see that. So that's an encouraging sign. And then, if the weather pundits are accurate, it feels like we're going to roll into somewhat of a normal winter, which I think will be very constructive for short-term commodity prices. Now, if I flip to long-term, what are some of the long-term drivers that are driving the sector? I think there's really three big drivers that I think have emerged over the last 6 months. The LNG is coming. There's about 7 BCF that is, quote, under construction. So that's coming, and we can debate and talk about timing of when it arrives. But over the next 18 to 24 months, that demand is arriving. I'd say the other significant item is the power demand. We've had a fundamental change in terms of where we believe electric demand is going in the next decade. It feels like we're in a cycle where we're going to see about 2% annual growth on the power side. The last time we saw that was really 20 years ago. It was really when we had the last major natural gas generation build out in the country. We had that kind of power demand growth year over year. A lot of that's being fueled by data center demand. But the other component, the third component that's showing up, is all this onshoring of industry back into North America. And as you listen to the political dialogue, both parties are talking about it. We're talking about bringing it home, for lack of a better word, bringing a lot of that manufacturing back home, creating more resiliency in the supply chain. So some of the lessons that COVID taught us the hard way, I think people are recognizing they got to bring things home. And depending on what happens this November, that may happen quicker or not. But I think the wind is blowing in the direction of bringing industry home. And that's going to also drive fundamental energy demand in North America. So I think those three items are large fundamental trends that support energy infrastructure, especially pipeline infrastructure. So I'd say those are the three big long-term fundamentals that I see playing out and that the market is beginning to recognize. I'd say the other recognition is the whole conversation 2 or 3 years ago used around energy transition. That's been really tamped down and tempered. And I think reality is setting in that we need all of the above energy solutions in this country. And reliable energy and affordable energy is very important to the country. And there's a recognition that natural gas is going to play a significant role in that over multiple decades. And there's also a recognition that the infrastructure, so the pipeline infrastructure that's used today to meet our energy needs, it meets 1/3 of the energy we consume in this country every day, natural gas infrastructure. It is irreplaceable infrastructure, period. I think more people are recognizing that and appreciating that. That you cannot electrify everything. You just can't. It is just practically impossible and cost prohibitive. So we need to be able to utilize this infrastructure long term. I think the pipeline industry has been doing a great job at laying out aggressive decarbonization goals for this sector, and is well on its way in meeting those goals. And I'd point your investors to the INGO website, which is the Association of All Natural Gas Pipelines in North America. And we publish those goals and we score ourselves against those goals every year. So we're making tangible improvements to decarbonize. It gives us the license to be part of this conversation for many decades to come here in North America. So I'll stop there, Yves. If you've got follow-up questions,
Yeah.
by all means.
Yeah, I think the industry definitely doesn't get enough credit for the decarbonization part of it, and the fact that the U.S. produces the cleanest natural gas in the world.
In the world, yeah.
Recognized as well. Just to follow up on the short term, do you think the hurricanes have had an impact on gas demand? Not really.
On the margin, it probably has, by knocking out some power demand. But I think, the natural gas infrastructure, wasn't impacted by any of the hurricanes. And if anything, some production was shut in on the eastern side of the Gulf during the hurricane season. So that's probably modestly helped burn off some of the excess here in the fall, the storage excess.
What worries me, among a lot of things, but one of the things is everyone's talking about power demand, the AI data centers. And, I just wonder if the infrastructure will be in place to actually support it. And so the question to you is, what do you see as potentially the gating items that might prevent the electrification coming to pass as soon as people think?
I think the biggest item is enabling construction of major facilities. And I'm going to be agnostic on that comment. It doesn't matter whether it's electric facilities or gas facilities, whether it's pipelines or transmission lines. But getting ourselves in a position here in the country where we can actually go out and make large scale infrastructure investments with a regulatory process that is understood, clear, and predictable is paramount. And anybody that you talk to, that risk, and you can read Gas Daily, this morning and last week, and you just hear all these court interventions in regulatory approvals. And it's very difficult, as you know, to attract capital into these large projects when you have a very uncertain regulatory process in the country. So I think permitting reform, which is being talked about by both parties in Washington, needs to be a priority on the other side of the election cycle this year. And in my opinion, Yves, that's the biggest item that needs attention, that will help enable these investments that are going to be required. I mean, we're on the verge of reliability issues across the country on the electric side. And, my personal opinion is it's probably going to get worse before it gets better. And that's going to attract a lot of public attention and create a lot of political anxiety around the country in different jurisdictions. And that won't be enjoyable to go through, but unfortunately, I think we may need some of that kind of pain to encourage the change that's required to allow companies to build this infrastructure that's going to be foundational to the country for the next century. That's the bottom line.
Yeah. Well, we do well under crises, not so well leading up to the crisis, unfortunately. having said what you just said, and I heard that you said that permit reform has bipartisan support, but do you think the election will have ramifications, either way?
I think regardless of which color wins, I think we're going to be moving in the same direction. It'll just be a question of the velocity of that movement, how quickly we move. I think a certain color we're going to move quicker than another color, but it's probably more than just the White House. It's what happens in the Senate and Congress that's going to matter a lot as well. How that balance of power settles out through this election cycle is going to probably be as important as who's in the White House.
When you look at your assets, are there any states that you're involved with that may be problematic in terms of getting infrastructure built?
No, I mean, other than, New York would be the poster child of problematic, but I'll say this, what we're hearing on the ground, even in New York, the tide's shifting in New York. There is a recognition that there is a problem and they need to resolve the problem. So I'm optimistic because even in some of the states that have been incredibly progressive, I think the recognition of those long-term fundamentals that I listed at the beginning, they're recognizing that. They're looking at their constituents and saying, the cost of energy is just going through the roof. And a lot of that's being driven by some of these policies that they've implemented. Renewables are coming in much more expensive than what was advertised. And as you restrict conventional energy, you just drive those costs up, and it's becoming unaffordable for many of their constituents, and that has political ramifications.
What about the EPA? Have they pulled back from requiring natural gas plants to have carbon sequestration, or is that still part of the?
That's being challenged, and I think has been stayed. But I'd say the current administration's all of government approach to a certain energy outcome, a lot of those initiatives have been, I'd say Chevron decision by the Supreme Court is really kind of tap the brake on that and like saying, hey, you cannot run outside your mandate. If you don't have the congressional mandate to do these things, you
Right.
need to get back in your swim lane. So I think that was a really constructive decision. But again, I think I'm optimistic that we're going to get a new administration and there's going to be this recognition of these fundamentals that I talked about.
Right.
And there's going to be some acknowledgement that you can't play around with energy and mess up your energy system in the country. It'll have just massive economic impacts for the country. And it feels like we're starting to move in the right direction, but that's an early call. And I'm being optimistic. So time will tell.
So what's your call on natural gas prices? And this is maybe a three-part question. Number one, where do you see natural gas prices going? Number two, why do you think in this low commodity price environment, your stock and the midstream sector has decoupled from commodity prices? Having been around a long time, I remember gas prices go down, these stocks go down, but that hasn't been the case. And the third is how do you view the producers in terms of natural gas prices? What price do they need in order to get more gas to the market?
Yeah, why don't I start at the end there, because I think that kind of answers the first question. So I think producers, again, have exhibited discipline, significant discipline through this cycle. by either shutting in production or restraining new drilling. And the decline curves have been kicking in, and you see it most clearly in the Haynesville. Haynesville's down 2 BCF a day from where it was a year ago. So with shale production, you've got pretty steep declines, 25 to 30% in the first year of a well. So when you slow drilling down, it doesn't take long for production to start to come down. And it also takes a while to get production back up again, because you get on that decline curve, and it takes some effort to stop it from going down and then turn it around and grow it again. So I think that discipline ultimately is driving this price recovery that I believe we're in the early days of experiencing in the short term. But long term, these producers need like a $3.50, $4 price to what I'll call sustain production at the levels that we require for the domestic demand that we have. So I think that's where the market will navigate to over time. That being said, I do believe we're in a period of time, a decade of high volatility, where we're going to see lots of highs around that number and lows, just like we've experienced. This past summer, we're $1.20 in Appalachia, or $1 sometimes in Appalachia. 2 years ago, we were $7, $8 in Appalachia when we were in the highs. So I think we're going to see a lot of volatility around that long-term average of $3.50 to $4. I think some producers are figuring that out, and I think that's probably why somebody like EQT has done what they've done, right? They've been trying to drop their cash break evens so that they can sustain themselves through a period of high volatility and take advantage of the highs and not be crushed around the lows. But so that's where I think we're going to need to be long term. And I think we'll be very sensitive to weather variations and exogenous variables that show up that affect the energy sector. It can spike the price in the short term. And again, this is where the lack of infrastructure, the fact that demand has grown, by a factor of twofold, and infrastructure has only grown by a factor of onefold, that disconnect between supply and demand creates a lot of this price volatility that I'm alluding to. Same thing's happening on the power side, where you have all this generation that showed up that's intermittent, and the retiring of your firm generation sources from the grid, that creates price volatility as well. So we've somewhat put ourselves in this awkward position of, through policy decisions over the last decade, we've actually created a lot of price volatility in the North American energy system. And I think that's going to also create forces that'll drive infrastructure investment to tamp down that price volatility.
And how do you account for the decoupling of the stock prices to gas prices?
Yeah, that's a good observation that you're making. And maybe we'll talk about our stock, DTM stock, and why do I think the stocks perform so well? I think you alluded to some of it in the opening remarks. Number one, we're a pure play pipeline company, gas only. We don't have any liquids or any oil in our portfolio. We have zero commodity exposure in the portfolio, so we have no latent commodity exposure, which many of our peers do. So we're the ultimate pure play. And over time, since we spun the company, we dialed up the pipeline segment from roughly 50% to 2/3 of the portfolio. And as you know, that's a demand charge based business. So high assurity of cash flows in that business. And then on our gathering side, that typically for most pipeline companies has a little more cash flow volatility in it, but the way we contract ours, it has significant firm demand charges buried in there as well. So again, I think our portfolio has this really high quality to it. The cash flows are very predictable. We went through this commodity cycle this year and we grew right through it. So, demonstrating the durability of the portfolio. We've been growing our dividend every year since we spun the company. We've delivered a 9% CAGR over the last 4 years, which is, over 2x the sector. So I think all those different features, a really strong balance sheet. We were just upgraded to investment grade last week by Finch. All of those different features, which I call quality features, I think has been recognized by the market. And that's been in large part why we've performed so well. And I think the other thing, just to be honest, Yves, is that, we're 3 years in now. So I think the management team was a new management team 3 years ago, kind of an unproven public company management team. I think we've proven that we can deliver what we say we're going to do. So I think that's another quality feature that sort of has rolled into the name. So long story there as to why I think the stock has performed so well, and the fact that we're completely decoupled from the underlying commodity price. There is no correlation to our cash flows on the underlying commodity price, I think is the driver as to why the stocks perform so well. And I think there's a better appreciation of that by the investment community. And some of those long-term fundamentals that we talked about are also being appreciated by the investment community beyond what I'll call the sector community, more of the generalist community. There's a general consensus that natural gas infrastructure is required and will be a foundational asset for the country for multiple decades. And I think that's bringing in new capital into the sector. And I think our strategy in that pure play approach has been an attractive vehicle for some of that new capital come in if they're playing natural gas in the long term. We've been a really good investment vehicle for that capital.
Yeah, I would add one other one, and you probably just have too much. You're just way too humble. But I would add, execution. I guess under promising and over delivering. You've been able to put up really good numbers. So I would add that as one of the reasons why the stock has done so well. But just sticking on DT Midstream. Yeah, how do you? And I apologize. This is not one of the questions that I put on this that I'm going to ask, but your growth projects seem to me to have been more supply push than demand pull. Can you talk about what you're seeing from the supply side and the demand pull? And when you look at your earnings, how much is it coming from producers versus end use customers?
Great question, Yves. So here's how I think about that, and I'll start at the highest level. We have an integrated network, right? So if I've got a producer that wants to plug into the network, it may look like a supply push, but they're getting the benefit of the network. And I'll use Louisiana as a great example, is that connecting into our Haynesville infrastructure in Louisiana, we are the best connected infrastructure to existing and proposed LNG in the Gulf Coast, period. Nobody else comes close. We're connected to almost every facility down there, directly connected. So if you're on our network, you get access to, I go down the list, Sabine, Calcasieu, Golden Pass, Cameron, Plaquemines, just go down the list. You can sell directly to those markets on our network. So it may look like a supply push when we announced that gathering business on the last quarter in East Texas. But that customer understands the value of the network, and if they've got choices of what network they want to plug into, they want to plug into the network that gives them maximum market connectivity. So the same is true in the north. When you look at our assets, they're all interconnected. The the activity that we've been doing there has the same features where, these producers that are drilling, new acreage, and they need to connect the acreage to the infrastructure. They're making conscious decisions about, what infrastructure gives them the best netback on their products. So that's one of the strategies that we've got across our network, and I think that's played very favorable for us over the last 3 or 4 years, and has been fueling a lot of the growth that we've been able to deliver.
And I should have asked this question before, but what do you attribute such great execution to in terms of being able to outperform your guidance, year in and year out?
I'd say there's a series of things there, Yves. I think number one is, we've been in this period of high growth, so executing those capital projects on time or ahead of time, which we've pretty consistently been doing, getting them in early and getting them in on budget, is huge. And I'm not going to name names, but you can name names. You know a lot of other companies in our business that haven't brought them on time and have had god awful surprises on the capital side that I probably wouldn't sleep at night if we were in that situation. So I think we just run a tight ship, and I personally look at these projects every week. We have a culture in this company of transparency, and there's expectations of performance. We're a very performance-driven company. Every employee in this company owns shares of this company, right down to the front line, right down to an administrative assistant is an owner in this company. And that's not normal. Most of our companies in this sector do not have that level of ownership embedded into every individual in the company. So that creates some passion and some alignment, I'll say it that way, across the entire organization for performance. So I, and I'd say that the culture, we've consistently been rated by third parties as being one of the best midstream companies in the country. We earned the first prize 2 years ago, and this year, when the same survey was independently done, we earned the second prize. And the two companies that were first and second, we just flipped with each other, and our scores were like right on top of each other, just a smidget apart. So again, this focus on our customer and delivering for our customer and performing at a level that matters to our customers is, again, just embedded in the organization. And I think that has played its way through with our robust backlog of commercial opportunities. We're very commercially minded. We're focused on execution, and that drives value for customers. And I think in many cases, when it's a toss-up between two pipeline companies, we win in those cases.
I feel badly Jeff is just hanging out there, so I'll ask Jeff.
That's a hard question.
Oh, these are all easy questions, but you're out there with $1.3 billion backlog for investments from 2024 through 2027. And you're also, hopefully that's right, 24 to 27. And you also have a breakdown between pipelines, which is, I think, 60%, 20% gathering, 20% energy transition. So I'd like to ask you about those projects. But before I do that, I'd like to ask Jeff, what are the targets that the company has? And I gave one out, but in terms of EBITDA growth, balance sheet, and CapEx over the next few years, and dividend growth, capital allocation.
Right. Yep. Yeah, absolutely. So Yves, what we're, just following on what David has said, again, with our our play is, based off that backlog is our long-term forecast is to grow our EBITDA at 5 to 7%. As David talked about, historically we've grown the EBITDA, over 9%. Now, along with that, as part of our play is then that we're going to also then grow dividends in line with the EBITDA. And that also historically has been around 7%. So again, 5 to 7 growth on the dividend. It's historically been about seven times. And then also part of our play is, you talk about that backlog. Well, that backlog for us is that's going to be fully funded with our free cash flow minus the dividends. I mean, that's all going to be done internally with our cash flow. So then what that means is then what we also strategically want to make sure is that we've got optionality in our balance sheet. And so we will naturally delever, just like we have since we spun. We'll naturally delever because we don't need any external funding for our growth. We'll delever both our proportional and on balance sheet leverage. We'll move down proportional down into the 3.5s, and then on balance sheet down into the the low 3s. Maybe even a little bit below 3. So that's kind of our capital allocation play and sort of what we see as the metrics playing across that. And because of that, that's why our EBITDA has done what it's done. The dividend's been growing, share price has been doing well. David mentioned Fitch. We're on our path to investment grade. Fitch is already there. Moody's is on positive outlook. And then S&P will also be following, we believe, along pretty quickly after that, either by the end of the year, first quarter, kind of a play.
That's great. So could you see a situation where you outspend your CapEx? And you just remind us the CapEx range around what was it?
Yeah, so for 2024, what we've got out there is 330 million to 375 million. And that's, at the top end, that's probably in and around the cash flow. So again, there's a little bit of excess there. And that's probably pretty consistent through the 5-year period. And again, if you do the math, that kind of ties out to that 1.3. And so you're right on all these projects. We can write them down. Nothing comes in exactly how you want it to. So again, by having that, we call it dry powder, or sort of that, strength of our balance sheet. There could be some periods, and again, we're talking timing across months here. There could be, more cash flow usage in one year versus another and stuff. But again, given their strength and those things, we don't see that as a problem.
What are the governors on CapEx? What are the governors in terms of approving new capital projects?
Yeah, so we've got a pretty stringent view around the deployment of capital. And that goes to, we make sure we look at the pipeline segment and look at what are the hurdle rates, the rate of returns that we want there. And then we also do the exact same thing on the gathering side too. And that range that we've provided on a build multiple is about 5 to 8 times. Lower end is on the gathering side. Higher end would be on the pipeline side. And that philosophy has worked really, really well. And that's what's been fueling our growth. Yves, the other piece is these capital projects and deployment is short cycle. That also allows us between decision and in-service date, like David talked about. So again, when you deliver those on budget and able to hit your targeting or even sooner, that cash flow return starts turning on pretty fast. That also, again, is also what's fueling the strength of the business too.
That's great. So, well, thank you for that, Jeff. I want to make sure that I'm mindful of the time because I do have a bunch of questions. How do you? Well, number one would be the Chesapeake Southwestern merger. How has that impacted the company? I'll just maybe instead of asking you 3 and 4-part questions, maybe I'll try to ask you one question at a time. So that's the question right now.
Yeah, I think the most immediate impact is it triggered the upgrade by Finch, right? they're an investment grade entity. XE is an investment grade now, and we are a knock-on effect of that. So we're investment grade with Finch. So I think that's the immediate effect. I think as they integrate, and we know they're busy integrating as we speak, we'll get more clarity when they, and again, they're a public company, right? So we got to be careful what we talk about here. I think once they come out publicly with kind of the new plan, we'll be able to provide more clarity on how we believe that new plan impacts what I'll call our current plan, which is kind of the old SWIN plan.
And David, if I can is also with the upgrade of Chesapeake SWIN, that moved our customer base, over 85% of it is investment grade. So, before, we called it Rising Star, and SWIN is in that low 40s. It's, from a total customer concentration. So now we're over 85% is investment grade. So again, David talks about the quality of the portfolio. You've got all of those, and then the customers using our network are, all pretty predominantly in the investment grade sector.
Is there an issue of concentration of the customer base? Because, the new company represents, fairly large portion of the.
We've actually been driving that concentration risk down since we spun the company. That's been one of kind of our strategic goals, is to dilute down that risk. And I'd say, when we spun the company, that risk was around 50%. It's now around 40. And it's likely going to continue to go down as a lot of this new business we're not doing directly with XE. We're doing with new customers.
All right. How do you view Haynesville, versus Appalachia? So you have expansion projects in both regions. But in terms of feeding, the power demand in the LNG markets, do you think we need to see more gas from both basins in order to feed that? And how difficult is it to be able to get gas down from Appalachia? And you might want to talk about MVP, how that factors into the equation. And you also might, within that context, maybe just explain your assets a little bit, because you also serve Canada to a certain extent, and the Midwest. So
we do.
Yeah,
I'd say, if we just unpack that a little bit, I'd say the LNG demand that's coming will predominantly in the near term being the next 3 or 4 years, be supplied by the Haynesville. It's the most proximal. There is new infrastructure being built, one of the few places in the country where infrastructure is getting built. There's 2 other pipes under construction as we speak that will enable that basin growth to directly serve the LNG demand growth. So I'd say that's how I think about Haynesville, and it's very focused right now on serving that LNG demand that's under construction. Appalachia feels very different. I do not see Appalachia incrementally serving the next wave of LNG demand. There isn't capacity, and it's very, very difficult and very, very expensive to build a new capacity from Appalachia down to the Gulf. That may happen, 5-10 years down the road. That may be required, but I'd say, in the nearer term, I'd say any Appalachia activity is going to be predominantly focused on the region that it serves, which is kind of Northeast New England, Midwest Canada. That is the primary market area that Appalachia production is serving. And, where you see it most predominantly is you can see when you look into the Midwest, Wisconsin and Minnesota, those that have become the highest price markets in this region. And that price signal, that strong basis price signal, is calling for more gas from Appalachia. And there are projects out there that are pursuing that as we speak. Some of our assets are part of that. So that's sort of where I see Appalachia gas, and there's a lot of data center demand showing up in the general Appalachian region. So from kind of Chicago right across to, Virginia, that whole section of the country, that midsection of the country, has got about 2/3 of the data center development activity occurring in that region. So I think Appalachia gas is very well situated to pursue that market segment as it grows and emerges.
Are you having direct conversations with data centers?
We are it's been probably one of our most active commercial areas in the company is, and I'll maybe redefine that a little bit, data center / power demand developers who are like symbiotic with the data centers, because a lot of data centers are talking about behind the fence generation. So they're bringing in, power developers to do the behind the fence generation, and then they become the host of that power. So a lot of conversations going on across our entire footprint around those activities. I suspect the same thing's happening with all of my peers. And, I think you'll start to see, commercial announcements, next year sometime. I think there's just a lot of, my sense, Eves, is that the data centers, for every 3 sites they look at, they know they only need 1 site. So there's a lot of churn going on right now, trying to advance sites to a point where they can be developed. Some of these sites are going to fall off, and then some of these sites are going to move forward to FID and development. So, we'll see how that all plays out, but I'd be absolutely shocked if we don't win our fair share of that business. It's just so much of it coming through the front door right now.
And this might be a Jeff question as well. When you're talking to these end users, what I'm not sure how much you can talk about the type of contract that you want to enter into, but if you could give any color in terms of the tenor of the contract that you might be looking at. And after you answer that question, I'll tell you why I sort of asked it.
Do you want me to tackle it, Jeff? Or?
Yeah.
I think these are going to be, I would look to our Birdsboro project as a good analogy. So just for the audience, Birdsboro is a pipeline, a FERC pipeline that we built to the Birdsboro Power Center. It was an IPP power center built in Pennsylvania, 20-year contract. They have a long-term offtake of the power plant. It's all what I'll call back-to-back. They're financed, the long-term PPA, long-term pipeline contract to get the fuel to the plant. That's what I would expect to see in these deal structures, Eves, is significant term commitments to underpin the capital investments required by the ultimate customer. And typically the ultimate customer, when you get through all the people working on it, is, the Googles, the Metas, go down the list. It's the big, large tech companies.
So when you sanction these projects across the company, what kind of recontracting do you embed in sanctioning these projects?
Zero.
That's great. Well, that's even a better answer than I was hoping for. And the reason I asked that question, and I'm obviously curious on the way you think about it. This morning, Amazon and I think Ken Griffin, announced looking at small nuclear projects, SMRs, and I don't think that technology is ready for prime time, but in 10 years it may very well be. And so I just wonder if you think that could eventually, perhaps, especially behind the meter, displace natural gas power plants, when these contracts, come up for renewal? Or is it, who knows what the environment will be like back then, in those
Yeah,
years?
that's why we have zero in the economic model. The economic model has to stand on the primary term of the contract. And we're not going to take massive renewal risk, hoping for something in 20 years when God knows what's going to happen in 20 years. I will say, we are watching a lot of the nuclear announcements. It seems like everybody's making a nuclear announcement. Coming from a company that built and operated a nuclear plant, you better have a backbone if you're going to stand behind a greenfield nuclear project, because I've never seen one that has ever been on schedule or on budget ever. And if you've ever seen one, please tell me, because I've never seen one.
Well, having said what you just said, I'm not even sure if, and I actually have an investment in one of these companies, but I'm just not even sure that restarting old plants is going to be able to come in on time and within budget, so, we'll see how that plays out down the road. But maybe now we can just transition and talk about the capital projects that you have, that you're working on. And when you talk about the Haynesville, because you have a potential for a further expansion, maybe, talk about the dynamics, going on there.
Sure. Yeah, I'd say some of the things that we've talked publicly about that we're actively pursuing right now would be our phase 4 expansion in the Haynesville system, which would bring incremental capacity down to access the growth in the LNG market. So feeling very optimistic on that, and stay tuned on that one. Up in the north, we announced 2 quarters ago a new interconnect with Mountain Valley. And I think we've been talking publicly that that was anchored by one shipper. And once we made that project public, we have looped back with all the other shippers on the system to see if they wanted to tag along and upsize it. So I'd say that's a focus for us right now. So stay tuned on that. I'd say the other, we're in flight on a handful of open, expansion opportunities. I'll just leave it at that on both Millennium. There was an open season on Millennium, Nexus, and on Vector. So again, these are all early cycle, but the thought there is incremental expansions kind of inside the footprint, relatively easy and not that impactful, environmentally impactful, to incrementally expand the capacity. So those are things that are actively being worked in our portfolio. I'd say the other item that's kind of new and really interesting, Eves, that I think we're excited about is our clean fuels business. So the project that we announced on the last quarterly call, just as way of background for everyone on the call here, clean fuels is there's a lot of state by state mandates that clean fuel standards. California was kind of the first to kind of start this many years ago, but is being picked up by a lot of other states here in North America, where they're coming out with clean fuel standards at the state level. So the demand for these, quote, clean fuels is growing at a very rapid pace in the country right now. And there are attractive tax credits in the IRA and in some of these state mandates to kind of spur investment in this area. So the project that we announced, where we're capturing fugitive coal bed methane emissions from an old coal mine, it qualifies as a clean fuel. It has a really, really low carbon score, because you're pulling methane that would have otherwise vented into the atmosphere, and you're taking it out of the atmosphere and getting it into the pipeline network. So that's really a really interesting project, and we think there's opportunity to do more of those projects across the country. And it's attacking this clean fuel segment that is growing, exponentially growing right now in the country. And one of the biggest challenges in the clean fuel segment is to find feedstock. So the traditional feedstock has been landfill gas or RNG. Well, that's very finite. And most of those opportunities or those feedstocks have been tapped into and developed. And as the demand keeps going up exponentially, finding the feedstock to meet that demand is going to become the challenge. So we believe this is a new feedstock that has some scalability to it, and it uses our core expertise. I mean, we're gathering from wellheads, we're processing and making it pipeline quality and putting it into interstate pipelines, which is kind of right in our wheelhouse in terms of our competencies. So,
And it meets your returns hurdles.
yeah, and they're very attractive projects from a return perspective because of the tax credit enhancements that are attached to these. So, you know, there are RNG type returns, Eves. So yeah, very attractive in terms of capital deployment, and they're nice and bite size. Like they're not 200-300 million capital projects, right? They're nice, small, bite sized projects that for us really move the needle and have very definable, manageable risk profiles to them. So for us, they're really nice projects.
Yeah, I want to be mindful of the time, but I said that 10 minutes ago, I think. But you know, your 5 to 8 times target. When you do these, I might mischaracterize it. It's sort of extensions of existing systems. When you look at, you know, potentially doing a Leap 4 project, and the Millennium and Nexus and the Vector, you know, if that just means more compression, why wouldn't your returns be greater than that 5 to 8 times range?
They usually are. Usually when we're incrementally doing something on an existing system, they tend to be much more accretive and higher returns. I'd say that that generalization that Jeff described, that would be like a virgin new piece of asset that goes in. So I'll use a clean fuel project as a good example. I mean, that's like virgin, like we're building everything new. And those are the kinds of targets that we would put on projects that are really effectively new projects, you know, like a new lateral to a power plant. That's a brand new project, right? So we want to have a base return that would be in those bands. If we're doing a project where we're plugging something incremental into the network, and especially if the network doesn't really need to be expanded or it's really modest, it's just a plug-in, that's going to have that'll have a multiple that's so ridiculous it's not even worth talking about. But those aren't always opportunities that present themselves, right? Those aren't those don't show up every day. I'll say it that way.
This may not be a fair question, but of the 1.3 billion of capex that you described, how much of that falls into the to what we just described as returns outside that 5 to 8 band?
Great question. I knew you're going to ask that question when I answered it that way. We won't provide that publicly as to, but let's just be honest. I mean, that is the Goldilocks project, right? When we find projects like that, those are very attractive projects that we will always vigorously pursue. But you can't deploy all your capital on projects like that. You've got to have the meat and potatoes projects. And I'd say, you know, the lion's share of our projects are what I'll call meat and potatoes projects, where it truly is incremental and it needs to stand on its own 2 feet and cannot be subsidized by an existing asset that you've already got. Now, having said all that, what I said at the beginning is almost all of our assets plug into everything else. There is a halo effect that we experience downstream of a project like that could be purely incremental, that we never put into our economics, but we know as business people will show up over time, right? So when we add acreage to the Haynesville network, for example. We know that by adding acreage, we create longevity to the network, and we likely drive incremental production to these LNG terminals on our network. We know that. We don't factor that into the economics when we're looking at that gathering deal.
Yeah. What I love about my career is that I get to ask all these questions, and from your side of the fence, you don't have to answer them. So I think it's, I should have said that right at the outset. So I apologize. But let me just ask a couple more questions. And again, I really appreciate your time. How do you think about the carbon capture and hydrogen, and how are they playing out for the company?
Yeah, so our carbon capture project, we're very excited about it. And just as background, we're capturing CO2 emissions from our treatment plants in the Haynesville Basin, where we have a very pure form of emissions on those plants as we treat the gas to make it pipeline quality. Right now, we are still waiting on the Louisiana DNR to finalize their Class 6 application. As you'd expect, we're talking to them constantly and encouraging them to get on with their business, right? They requested primacy from the feds. They got it. Now they have it. Let's get on with it. So we're expecting that those requirements will be finalized very soon, like any time now. Once that happens, we'll then complete our application, and trust me, they have everything that we have already. So I'm hoping the application is like 95% complete already. And whatever the last few things they add, we'll be able to complete in short order. Once we do that and have it filed and deemed complete, then I think, the next step for us is going to be, determining the FID schedule, like when we want to FID the project, and getting a sense from Louisiana as to the timing of receiving the permit back, right? So I'd say that's the window that we're in. We're in this, I'll call it regulatory window, where these are new projects. The regulators are trying to finalize the requirements. We'll need to get through the public process and get to the other side of having the Class 6 well permit approved. And then after that, I think it's pretty straightforward for us. We're going to be building a CO2 pipeline, and it's not very far, and doing a injection well. And again, we have all of our storage rights. We have the pipeline right away. We're working with the local communities. We're very advanced and taking a very disciplined, methodical approach to this development. We're just waiting right now on the regulatory process. We're waiting on the agencies to move this along.
Okay, I promise the last three, we can hit them pretty quick.
Sure.
What the government giveth, the government can taketh away. So, so how concerned are you, with the tax credits, underwriting some of these, projects?
Yeah, that's something that we spent a lot of time looking at for the reasons that you just described. We feel very confident on the carbon capture side that is going to be a durable tax credit. There's many projects in a similar state as ours, kind of waiting on permitting and capital being deployed. And for certain parts of the industry here in North America, it's really the only way to decarbonize it for some of the very carbon intense industries. So we're feeling confident on that one. For the clean fuels, there's a whole series of tax credits that the clean fuels can qualify for. And again, there's different pathways. So again, the tax credits are very front loaded. They're shorter term. So again, I think if administration does change the short-term nature of those tax credits, they kind of fall off on their own anyways. So I don't think the credits that we're focused on are going to be in the crosshairs for a new administration. What we're hearing could be in the crosshairs of a new administration is the large capital infusions for hydrogen hub development. that is very kind of blue skyish, like no clear line of sight to commercialization. And some of the EV subsidies that exist. What we're hearing in Washington is those would be kind of right in the crosshairs first up if the administration did change. And some of these other tax credits are, from a scale perspective, much smaller, very targeted to clean fuels. And you've got all these states initiating clean fuel requirements. So I think those are less suspect to being attacked by a new administration and have a lot of support across the country, state by state.
Yeah. So do you have any views on hydrogen?
Hydrogen, I think hydrogen is going to be a long-term play. I think green hydrogen is very expensive. I think the conversations I've been involved in have really focused around blue hydrogen. It's much technologically, it's lower risk. It's cheaper. It utilizes existing infrastructure. So you can get the hydrogen to where you need it to be, i.e. you put a SMR right in front of your power plant. So you can use the natural gas infrastructure, get the energy locationally to where it needs to be converted to hydrogen. And so blue hydrogen pairs very well in the power generation sector and pairs very well with the carbon capture and sequestration. So when you have abundant natural gas, the right location on the grid with the right geology, when those three things converge in the country, I think blue hydrogen for generation purposes is a really cost-effective, reliable resource on the grid that is like 98% carbon free. It's as carbon free, reliable, firm capacity on the grid as you can possibly get without if you step into batteries, you just move up. Like it's a step function change in cost, and it's not as reliable, right? Batteries have a limited ability to serve, whereas this type of generation is you can turn it on in 5 minutes, and you can turn it on for as long as you want or as short as you want.
Well, I want to thank you for your time and thank everyone that has stayed with us. But I do have two last quick questions, and I promise that will be it. The other is, do you have any views? Well, I'm sure you have views on M&A and consolidation. And then the last question, which is always my best question, is there anything that we missed that we probably should have spoken about?
Sure. Well, I'll try to do M&A justice here in the last couple minutes, but it's the topic du jour, right, in the sector. We're hearing announcements it seems like every month we're hearing an announcement. So our thought on M&A is probably this, is that we want to have, right, the highest quality company possible. We talked about that. We want to have strong organic growth that doesn't require or isn't premised on M&A. We have that. Those are two, we have a really strong balance sheet. The things that we have, a lot of other people may want, which is a great place to be, right? We fully understand our job is to maximize shareholder value. I mean, we get that. That's why we're here. That's why you're an investor, and all your clients are investors. So we get all that. Jeff alluded to the fact that we're building up dry powder on the balance sheet. So we also want to be able to participate in M&A if the right strategic opportunity presented itself to us, and we monitor this all the time, as you'd expect. What I will promise you, Yves, is that we will never change our investment thesis. You will never wake up in the morning and be surprised by any strategic moves that we make. We're a pure play gas pipeline company that's highly contracted, has predictable cash flows, and on the risk continuum of midstream, we're on the low risk side. We're on the predictable side. That's never going to change. So if the market presents opportunities like that, where things kind of bolt on and plug in, we'll certainly be curious and inquisitive on that, but it's going to have to make sense. It has to fit strategically. It has to drive growth over time. And it would have to, be very obvious to everybody that bolt-on would make a lot of sense. So.
Yeah, and I think for the audience, you have a pretty good track record of making pretty good acquisitions that have played out over time as well. So, any questions? Anything that we left out, David, Jeff, that you'd like to?
No, this has been really good, Eves. You've covered the waterfront. I think you've hit all the themes that are kind of circulating right now in the space. So appreciate the time, and again, appreciate your support and all your investors. We're happy that they're owners of the company, and we look forward to continuing exceptional performance for many, many years. So,
all right, guys, thank you so much, and hope you do great through the end of the year, and we'll see you soon.
Very good.
Thank you.
Thank you.